the S&P 500 is near all-time highs, up about 130% since the start of 2020. And at the same exact moment, consumer sentiment in America just hit 44.8, the lowest score ever recorded, lower than during the 2008 financial crisis, lower than COVID, the lowest since the survey began in 1952. The stock market is at record highs, and regular Americans feel worse about the economy than they have ever in modern history. How is that possible? And more importantly, what does it mean for your money? The world has flipped. We all learn the same story about how the economy works. Companies hire people, people earn money, people spend money, the economy grows, and the stock market goes up because companies are doing well. In that story, the economy is the engine. The stock market is just a mirror, reflecting how the engine is running. But something fundamental has changed, and the change is now so large that some of the biggest names on Wall Street are openly saying it. Morgan Stanley said this in November 2025, forecasting the overall labor market may now be less important than forecasting the direction of the market itself to anticipate the path of the economy. I'll say that again. Morgan Stanley is saying, don't watch the jobs numbers first, watch the stock market first, because the stock market is now what drives the economy, not the other way around. What that means is the mirror became the engine. The economy flipped. How did this happen? It starts in April 2020. COVID hits, unemployment spikes from 3.5% in February to 14.7% in April, the fastest collapse in American employment history. But something strange happens almost immediately. The stock market bounces back hard. White-collar workers go home, keep their salaries, keep investing. Service workers and low-wage workers lose their jobs or get stuck in dangerous essential work. Two very different recoveries begin at the exact same moment. An economist named Peter Atwater, borrowing a term from anonymous Twitter user, gives this a name, the K-shaped economy. Draw a letter K. The upper arm goes up, the lower arm goes down, both at the same time. The K-shaped economy was widely talked about in mainstream media in 2025 and 2024. What we'll see is that it has become worse thanks to AI, and it may help us understand where the economy is headed next. For a brief window, 2023 into early 2024, the K actually compressed a little. Wage growth for lower-income workers briefly outpaced the wealthy. People thought it was healing. Then, in late 2024, it snapped back wider than ever. By Q2 of 2025, the top 10% of Americans were responsible for 49% of all consumer spending. The top 40% of households controlled 85% of America's wealth. And those households' wealth is almost entirely tied to one place, the stock market. Here's the critical link. Consumer spending is about 70% of GDP. If the top 40% drives 60% of consumer spending and their wealth is tied to stocks, then the stock market's mood directly determines where the economy grows or contracts. And here's the data that makes this concrete. Oxford Economics found that every dollar increase in stock wealth now leads to 5 cents of consumer spending. That sounds small, but in 2010, it was less than 2 cents. The wealth effect has more than doubled in 15 years. Visa's research found it actually quadrupled in the post-pandemic era. JP Morgan's chief strategist David Kelly said, changes in asset prices may have a greater effect on consumption in 2026 than they have in the past, and might even outweigh economic data from other segments of the market. The old economy was driven by wages. This economy is driven by asset prices. The K-shape is not just an inequality story. It is a structural rewiring of how the economy actually functions now. AI made it extreme. Now here's where it gets more urgent. If the stock market is now driving the economy, the next question is, what is driving the stock market? And the answer for the past 3 years has basically been 7 companies. In 2023, the S&P 500 gained 26.3%. The Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, were responsible for 62% of that gain. Without them, the index would have been up just under 10%. In 2024, the story was nearly identical. The Magnificent Seven drove around 60% of the S&P 500's total return. And here is the longer arc. In 2014, these 7 companies made up less than 10% of the S&P 500's total value. By mid-2024, they were nearly 35%. What is powering the Mag 7? Artificial intelligence, of course. In just 1 year, JP Morgan estimated that U.S. households gained over $5 trillion in wealth from just 30 AI-linked stocks. That wealth gain translated into roughly $180 billion in additional annual consumer spending, which then flowed into restaurants, travel, luxury goods, and real estate, which held the broader economy up. So the chain now looks like this. AI investment lifts tech stocks. Tech stock gains flow to wealthy households. Wealthy households spend more. That spending holds the economy together. The economy looks fine, so more money flows into AI stocks, round and around. It is a feedback loop, and it is powerful when it works. But something built on a single thread is fragile. That's the top part of the K. Now look at what AI is doing at the bottom of the K, because this is the part that most people are not connecting. AI is not just enriching the wealth, it is simultaneously compressing the lower arm, eliminating the kind of work that middle-class and entry-level workers depend on. U.S. employers announced 696,000 job cuts in just the first 5 months of 2025. This is an 80% jump from the same period the year before. The Federal Reserve Bank of San Francisco found that real wage growth, or entry-level professional jobs, actually fell 1.8% in 2024, even as the overall economy grew 2.4%. Anthropic's own CEO, Dario Amodei, said in early 2025 that AI could eliminate roughly half of all entry-level white-collar jobs within the next few years. These are not factory jobs or manual labor, these are white-collar jobs that college graduates were trained to fill. So AI is simultaneously lifting the top of the K and pulling down the bottom, steepening the shape in both directions at once. The bottom of the K matters economically. Oxford economics data shows that lowest income households spend more than 6 times as much of every additional dollar they earn compared to the wealthiest individuals. So when lower income people have less money, the economy loses spending power that the wealthy simply cannot replace dollar for dollar, no matter how much their portfolios grow. Morgan Stanley's chief investment officer Lisa Chalette called the 2026 economic outlook increasingly fragile for exactly this reason. And right now, the data is showing you exactly what fragility looks like in real time. The University of Michigan Consumer Sentiment Index just hit 44.8, the lowest reading ever recorded since the survey began in 1952, down 21% since February alone. Lower income households without college degrees saw the steepest drops. The very bottom of the K is under real stress right now. Meanwhile, the S&P 500 is near its highs. That gap between where the market sits and where regular people's confidence sits is the K-shape made visible. And it is not sustainable forever. The question every investor needs to be asking right now is, what happens when the K-shape closes? What this means for the retail investor. Let's get into what this means for your money, and I want to be specific because the institutions that manage trillions of dollars have been pretty direct about this in the last few months. Start with the most important thing to understand about this moment. The economy is now structurally dependent on a very small number of companies performing well, the Mag 7. The top 10 companies in the S&P 500 make up 40% of the entire index's value. That has never happened before in modern market history. And KKR said something critical in their 2026 outlook that every investor should hear. The economy is now reliant on AI capex, household wealth, and fiscal spending. And here is the danger. Those 3 things are correlated. They do not fall one at a time. If AI investment disappoints, tech stocks drop, wealthy households feel poorer, they pull back spending, the economy weakens, earnings fall, stocks drop further, like a domino. Morgan Stanley estimated there is roughly a 50-50 chance that AI delivers on its current valuations fast enough to justify where prices are. That's not a pessimistic view, it's actually a fairly neutral one. But a coin flip is not a foundation, it is risky. And the stress signals are already flashing right now in real time. The bottom of the K is under severe stress, and Fidelity's managing director of asset allocation, Dirk Hofscher, said changes in asset prices may have a greater effect on consumption in 2026 than in the past, and this might even outweigh economic data from other segments of the market. That is, Fidelity telling you the market is now the economy, which means a market correction does not just hurt your portfolio, it directly and immediately shows the entire economy. The single most actionable insight from every major institution in the last 3 months, including BlackRock, Morningstar, Cambridge Associates, Goldman Sachs, is this. Your portfolio has almost certainly drifted into dangerous concentration without you realizing it. Here's the math. A portfolio that started at 60% stocks and 40% bonds 10 years ago is now likely sitting over 80% stocks just from price appreciation alone, without you doing anything. Morningstar's portfolio strategist Amy Arnott published this in early 2026. Most people have not rebalanced, and of that stock portion, a huge chunk is probably sitting in US large cap tech. Again, just from index growth, not from any decision you made. You did not choose to be concentrated, the market concentrated you passively. Cambridge Associates said explicitly in their 2026 outlook that this is a timely opportunity to reassess and embrace greater diversification, not because a crash is coming, they're not predicting one, but because the risk-reward of extreme concentration has shifted. There are 2 areas in particular standing out right now for diversification. 1, international and emerging markets. Morningstar found that international stocks outperformed US stocks in 2025 and have continued to do so into 2026. BlackRock's spring 2026 report specifically called out emerging markets over developed international because emerging market countries are central to the physical AI build-out, semiconductors, data center hardware, energy infrastructure. Goldman Sachs's May 2026 Market Pulse noted that South Korean exports alone rose from $20 billion in December to $30 billion in March. This is a 50% jump in 3 months, driven entirely by AI hardware demand. So AI trade is global. Your portfolio probably is not. The second is gold. This is not a doomsday call. BlackRock's spring 2026 investment directions specifically flagged gold as a portfolio diversifier around currency debasement risks. VanEck called gold mining stocks the single most compelling opportunity in their space right now. Strongest fundamentals in decades, record cash flows, but still trading at a discount to the broader market. Wisdom Tree's research found that a 60-20-20 split, stocks, gold, bonds, delivered better risk-adjusted returns than the classic 60-40 stocks and bonds over the long run, with a higher Sharpe ratio and similar volatility. The deeper point connecting all of this is fragility. According to Capital Economics, an economy where growth depends on a small group's confidence and spending is an economy more vulnerable to shocks. When the wealthy pull back, not because they go broke, but simply because their portfolio drops and they feel less rich, they freeze. And when they freeze, 60% of consumer spending freezes with them. So to position yourself to be on the right side of the K-shaped economy, and to survive moments when the feedback loop breaks and the K becomes narrower, own quality large cap with real earnings. Spread your geography deliberately into international and emerging markets. Let bonds do their job again as a stabilizer, and treat gold not as a hedge against catastrophe, but as structural insurance in a market that has become structurally fragile.